Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Hey friends, David Robson here with Tax Smarts Unlocked. Today's solo episode is Smart Tax Moves for the Side Hustler, and it's all about keeping more of what you earn without losing sleep or receipts. If you drive, tutor, code, craft, flip, photograph, or consult after hours, this one is for you. I'll break down how the IRS views your hustle, why taxes can feel bigger on gig income, simple systems to stay organized, the deductions that matter, retirement and health plays, entity choices, and year-end tactics. I'll sprinkle in case studies and a few dad jokes, all to help you act confidently. Quick note, this is education, not personal advice. When in doubt, call a pro who knows your numbers. Let's begin now. First, what is a side hustle for tax purposes? The IRS distinguishes a business from a hobby. A business has a genuine, demonstrable intent to make a profit, even if you're not profitable yet. Think business-like behavior, such as keeping books, advertising, having a separate account, and adjusting your approach when something doesn't work. A hobby lacks that profit motive, and hobby losses are not deductible against other income. If the activity is a business, your net profit is taxable, and your ordinary and necessary expenses are deductible. Document your profit intent with a short plan, a budget, and evidence of marketing or pricing decisions. If you occasionally show losses, fine, but sustain the business habits that prove you're trying to win. The stakes matter. Second, why does gig income feel so heavily taxed? When you're self-employed, you pay self-employment tax on net profit to cover both sides of Social Security and Medicare, roughly 15.3% on most earnings, plus your regular income tax. Employees see FICA withheld, and their employer pays the other half. Side hustlers pay both halves. The good news, you can deduct half of the self-employment tax above the line, which slightly softens the blow. Your marginal bracket still applies, so $1 of profit could face, say, 15.3% plus 22%, depending on your situation. That's why planning, tracking deductions, and funding retirement can move the needle. We want every legitimate expense captured, early and often. Cash flow planning matters here. Let's build clean money habits that save tax and sanity. Open a dedicated checking account and a business credit card for your hustle. Run all income and expenses through them. That separation makes bookkeeping simple, supports your profit intent, and protects you in an audit. Use a basic bookkeeping app or a spreadsheet with monthly tabs. Reconcile bank and platform deposits and tag every expense to a category. Snap receipts into a cloud folder the day you spend. Create a mileage log now, not on April 14th. Block 30 minutes monthly for a finance date with yourself to review profit, cash, and upcoming obligations. Finally, record owner transfers clearly, distinguishing contributions, draws, and reimbursements under an accountable plan. Small routines beat heroic catch-up, always. Next up, pay-as-you-go taxes. The IRS wants taxes paid during the year, not just in April. Side hustlers usually satisfy this with quarterly estimated payments. Due dates are April 15th, June 15th, September 15th, and January 15th of the following year. To avoid penalties, hit a safe harbor. Pay in at least 90% of the current year's total tax, or 100% of last year's total tax. If your prior year adjusted gross income exceeded $150,000, use 110%. Wage earners can also adjust W-2 withholding instead of writing quarterly checks. I like a weekly sweep into a tax savings account, then automate estimates. Consistency prevents surprises and helps you sleep better between launches. Complex situations warrant a pro's guidance now. Let's talk income reporting. Clients may issue a 1099 NEC when they pay you $600 or more for services. Payment platforms may issue a 1099-K for gross payments processed, with federal thresholds evolving and some states using lower thresholds. Here's the key. Your income is taxable, whether or not a form arrives. Reconcile platform statements and bank deposits to your books, and keep a list of expected forms so nothing gets missed. Separate refunds, chargebacks, sales tax collections, and shipping from sales, so you don't overstate revenue. If the 1099-K shows gross that includes customer-paid taxes or fees, your records should clearly offset those. When numbers disagree, your clean documentation is your best friend. It prevents notices and costly matching headaches. Now deductions. The rule of the road is ordinary and necessary expenses for your trade or business. Ordinary means common and accepted. Necessary means helpful and appropriate. Prove them with contemporaneous records, not guesses later. Keep receipts, invoices, mileage logs, and notes that explain who, what, when, where, and why. If you buy something personally and also use it for business, allocate the business percentage and be consistent. Subscriptions, website hosting, payment platform fees, professional education, advertising, supplies, bank fees, and business insurance all qualify when tied to your income. Track small items too. They compound. Use a simple chart of accounts so categories stay consistent across months. Your documentation should tell the same story your numbers tell. Keep records 3 years, assets longer generally. Let's demystify the home office. You qualify when you use a specific space regularly and exclusively for business. That could be a spare room or a clearly defined portion of a room. 2 methods exist. The simplified method is $5 per square foot up to 300 square feet. The actual method allocates rent or mortgage interest and property taxes, plus utilities, insurance, and repairs, based on business square footage over total. Track direct repairs to the office separately. Whichever you choose, keep photos, a sketch, and measurements. For phone and internet, deduct the business percentage of your plan. Many people land between 30 and 70%, supported by usage patterns. Be honest, be consistent, and document assumptions. Consistency wins audits and saves time. Vehicles are next. You can deduct either the standard mileage rate or actual expenses. For 2025, the standard rate was 70 cents per business mile, and it includes gas, maintenance, insurance, depreciation, and more. The alternative is to track actual costs and multiply by your business use percentage. Whichever path you pick, you must keep a mileage log showing date, purpose, start and end locations, and miles driven. Commuting from home to a regular job site is not deductible, but travel between business locations is. Car washes, parking, and tolls are separate deductions. Choose the method that fits your record-keeping and long-term vehicle plans, and be consistent year to year unless you properly switch methods. Logs today beat memories tomorrow, every single time. Seriously. Let's cover gear and startup costs. Thanks to the de minimis safe harbor, most small businesses can expense items up to $2,500 per invoice or item if they have a capitalization policy. Larger purchases may be deducted using Section 179 or bonus depreciation, both allowing big first-year write-offs when appropriate. Sometimes spreading depreciation helps manage qualified business income, state taxes, or future profitability, so decide intentionally. Startup and organizational costs, like market research, initial advertising, legal fees to form an entity, and initial software setup, can be deducted up to $5,000 if total startup is under $50,000, with the remainder amortized. Keep a placed-in-service list with dates, costs, and business use percentage. Document policies and revisit choices each December, deliberately. Rapid-fire playbook. Sellers track cost of goods sold separately and verify marketplace facilitator collection of sales tax. Platforms remit for you, and Missouri adopted these rules in 2023. Keep resale certificates and inventory counts. Hire freelancers. Collect W-9s up front and issue 1099 NECs for $600 or more. Avoid pitfalls like mixing funds, missing estimates, failing mileage logs, weak backups, and ignoring licenses. Retirement shrinks taxes. A solo 401k allows an employee deferral plus employer contribution, reducing the SE tax base, but must be established by year-end. A SEP IRA can be opened and funded by filing deadline. QBI may allow a 20% deduction on qualified profit. Consistent profits might justify an S corporation with reasonable salary. Wages influence QBI limits. Let's land this plane. We covered hobby versus business, self-employment tax, bookkeeping, estimates, 1099s, deductions, home office, vehicles, startup, inventory rules, retirement, QBI, and S-Corp. 3 spotlights. A rideshare driver leans on standard mileage and part of the smartphone plan. An Etsy seller tracks inventory and fees, claims a home office, and reconciles the 1099K to sales. A consultant sets up a solo 401k, including a Roth, trimming taxable income and easing QBI limits. Add health plays like the self-employed health insurance deduction and HSA contributions. Year-end, accelerate expenses, defer income thoughtfully, and true up estimates. Want tailored help? Book a proactive planning session with David Robson at Premier Tax and Business Services in Creve Coeur, Missouri by emailing info@premiertbs.com.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.